Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. This is the Deep Dive. And our mission, as always, is really to cut through the noise, extracting the most important insights from complex financial sources. Think of it as your shortcut, to truly understanding what's moving the markets and why it matters to you. Today, we're plunging into the dynamic and often surprising currents shaping global financial markets. We've pulled together a stack of recent reports and analyses from leading publications like the Wall Street Journal, Bloomberg, and Barron's, and our goal is basically to connect the dots on what's truly shaping the financial world right now. Let's kick things off with a really compelling story from the U.S. market. The S&P 500 has been hitting record highs, right? Significant gains year to date. It almost seems, counterintuitive when we hear about tariff concerns and, other economic headwinds. So what's the underlying strength? How are U.S. companies managing such robust performance?
Yeah, it's certainly been a surprisingly strong Q2 earnings season. It exceeded almost everyone's expectations, really. Aggregate S&P 500 earnings per share actually jumped an impressive 11% year over year. That's far surpassing the modest 4% consensus analysts had predicted.
Wow, 11%.
Exactly. And what's even more telling is that a remarkable 60% of companies significantly surpassed their forecasts. That means an unusually high number of companies surprised positively with their results. David Kostin from Goldman Sachs even called it one of the greatest frequency of earnings beats on record.
That's quite the beat. How did they manage to pull that off given the challenging environment, especially with tariffs looming?
Well, this quarter really revealed the surprising agility of U.S. corporates. They didn't just sort of absorb tariff impacts. They actively re-engineered their operations, their pricing strategies. We saw companies negotiating harder with suppliers, adjusting supply chains, cutting internal costs, and even passing some price hikes along to consumers. Now, it's worth noting, analysts had already lowered their estimates after President Trump's April tariffs. So that kind of set a lower bar for these beats,
Ah, right. Context matters.
It does. Plus, a weaker dollar also provided a bit of a tailwind for S&P 500 sales growth. And what's fascinating here is that recession mentions on earnings calls, they plummeted 84%.
84%.
Yeah, it indicates a real increase in corporate optimism.
Okay, given the S&P 500's overall strength, it's tempting to think, all boats are rising. But I've been hearing whispers of something more complex, an emerging bifurcated economy within the U.S. Is this divide as stark as it sounds? How's it manifesting?
It absolutely is, and it's a crucial insight for anyone looking at the U.S. market right now. Earnings growth is heavily concentrated. 2/3 of it is driven by just two sectors.
Only two.
Yeah, communication services and information technology. Think Meta Platforms, Microsoft, leading the charge. This immense growth is primarily fueled by the surge in AI investment. It's creating what some are calling windfalls. Windfalls for companies like NVIDIA, obviously, but also less obvious beneficiaries.
LICO.
Well, we're talking about GE Vernova, which makes gas turbines for data centers. Comfort Systems with their specialized tooling systems. Owens Corning producing insulation for these new facilities. So it's almost like a picks and shovels play, you see.
Right, the infrastructure behind the AI boom.
Precisely. Companies providing the fundamental infrastructure for AI are seeing significant windfalls, not just the direct tech giants. That's a crucial distinction.
That makes perfect sense.
Yeah.
So while some sectors ride the AI wave, others are clearly struggling. Can you give us a sense of who's on the tougher sledding side?
Exactly. In contrast, other sectors are definitely having tougher sledding. We're talking about areas like packaging companies, oil and gas drillers, many real estate investment trusts. For instance, Essex Property Trust, they lease apartments out on the West Coast. They openly blamed a lackluster economic environment in their recent earnings call.
Okay.
So this bifurcation is really crucial because it directly impacts your investment strategies and portfolio performance. It depends heavily on which sectors you're exposed to. It's definitely not a rising tide lifting all boats uniformly.
This brings us to the big question then. What does this all mean for the road ahead? Is this kind of concentrated growth sustainable, or are we maybe headed for a broader slowdown?
Well, corporate executives are definitely expressing hope. Hope that any U.S. growth slowdown will be short-lived. They're citing recent trade deals and tax cuts that are creating a more settled policy environment. United Airlines CEO, for example, noted a meaningful inflection point in demand.
So optimism from the C-suite.
Yes, but a word of caution is probably prudent here. Some investors are worried that stocks have just become too expensive. The S&P 500 is currently trading at 22.5 times forward price to earnings.
Which is high.
It's well above its 10-year average of 18.8x. Bob Dahl, CEO at Crossmark Global Investments, called it a high-risk bull market. His words were, "It's discounting a near-perfect world, and it's not perfect."
A sobering perspective.
Right. And while analysts are increasing Q3 earnings estimates at the swiftest pace in nearly 4 years, the full impact of tariffs on supply chains and profit margins might take months to really materialize, and that could potentially weaken those future analyst revisions. So this optimism, it comes with significant caveats.
Okay, among all these shifts, one of the biggest questions looming right now has to be the Federal Reserve. Will they deliver on market expectations for rate cuts? The bond market seems incredibly confident. Will the Fed actually deliver, or is there potential for market disappointment here?
Bond traders are certainly placing a huge bet, a huge one. They see a quarter-point rate cut next month as, well, virtually a lock, with at least one more expected by year-end. This Friday, Chair Jerome Powell's speech at the Jackson Hole Symposium it's critically important. Everyone's watching. Traders are confident that a weakening job market has opened the door for a more dovish Fed. Yet, some surprisingly hot inflation data has caused economists to, pause a bit.
Like the inflation piece.
Exactly. Powell's expected to remind everyone that policy decisions really hinge on confirmation. Confirmation that the labor market is truly cooling and that inflation is in check. We've even seen large option trades targeting a half-point move next month.
Half a point. Wow.
Yeah. And there's intensifying pressure from the Trump administration. Treasury Secretary Scott Bessent urging 150 basis points or more in cuts. Bond traders seem incredibly confident, but hasn't the Fed surprised markets with hawkish pivots before? What factors could genuinely throw a wrench in these rate cut expectations?
That's precisely the catch I'm hearing about. A potential hawkish surprise for investors betting on multiple cuts. Can you elaborate on that risk?
That is the significant risk right now, absolutely. Even if the Fed delivers a September cut, they could strike a hawkish tone. Signal a plan to keep rates relatively elevated to battle inflation.
Which the market is not pricing in.
Not at all. This would be a real problem for markets, which are betting aggressively on multiple cuts. Look, the Fed's preferred inflation gauge, the PCE index, it remains at 2.6%. Still above their 2% goal.
Still sticky.
Right. And remember, tariffs are causing businesses' costs to rise faster than consumer prices. That could stoke further inflation down the line. If the 2-year Treasury yield rises reflecting higher rate expectations, the S&P 500 could tumble by almost 5%.
Okay.
So from that perspective, it's really not the time to aggressively buy stocks if investors want to avoid disappointment. For you listening, it's going to be crucial to closely monitor Powell's message and, of course, the upcoming August jobs data on September 5th.
That picture of resilience, though, is largely a U.S. story, isn't it? When we look across the Atlantic, we find a starkly different narrative unfolding. Europe's stock markets, for example. Some are calling it an emergency. What's behind this drastic contrast?
Yeah, the data truly illustrates this crisis. It's quite striking. Only 6 companies went public in the UK this year. 6, raising a paltry $208 million.
That's incredibly low.
It's the lowest level in 3 decades. And IPOs in continental Europe have nearly halved compared to last year. Now contrast that with the U.S., where fundraising jumped 38% to $40 billion. And Hong Kong IPOs more than doubled.
So European companies are looking elsewhere.
Exactly. European tech stars like Klarna and Arm, they're choosing to list in New York, completely skipping their local markets. Even established stock market heavyweights like Wise and Flutter Entertainment are moving their main listings to the U.S., or they're being bought out by American companies.
Wow.
It really highlights a critical issue when London's total market value, around $5 trillion, is strikingly close to NVIDIA's $4.4 trillion valuation alone.
One company versus a major market.
Precisely. London's total listings have fallen by a fifth in just 5 years. And there's even speculation about AstraZeneca, the largest company in the FTSE 100, potentially moving its main listing to the U.S. They've already pledged $50 billion in U.S. investments by 2030, so...
That's a significant outflow of capital, of opportunity.
Yeah.
What are the broader implications for Europe and its citizens if this trend continues?
European leaders certainly view this as an emergency, no question. And they link it directly to economic stagnation, low productivity, and a widening wealth gap. Stefan Leithner, CEO of Deutsche Börse, put it quite starkly. He said, the wealth creation will happen to Texas teachers and California public sector employees, not to European pensioners.
Oof, that's blunt.
It is. Europe's core problem isn't really a shortage of money. It's an underdeveloped and risk-averse system for investing it. European households actually save more than Americans, but their wealth has grown by only about a third as much since 2009.
Only a third. Why?
Because a staggering 70% of European savings, that's $12 trillion, are held in low-yield bank accounts.
Just sitting there.
Basically, unlike the widespread stock ownership we see in the U.S. via things like 401k, and this contributes to significantly lower stock valuations in Europe. The S&P 500 PE is 22, right? Compare that to the FTSE 100 at 13, Germany's DAX at 15.
Big difference. Are they trying to fix it?
They're trying. The UK is pushing deregulation efforts, even launched a concierge service for businesses. And the EU has this decade-long 55 proposal project to integrate capital markets. But frankly, it's still bogged down in technical problems rather than making fundamental change.
So, slow progress on that front. Okay, if Europe is struggling with capital flight, China's markets seem to be having quite a moment, incredible resilience, a rally even. What's driving this impressive surge? It contrasts so sharply with Europe.
It's a stark contrast indeed, a real case of global market divergence happening right now. The Shanghai Stock Exchange Composite Index just hit its highest level in a decade. It jumped 0.9% on Monday alone. That marks a 20% turnaround since that sell-off back in April.
20% turnaround.
Yeah. This reflects growing optimism among small, cash-rich local investors. They seem to be actively rotating from bonds into stocks.
What's fueling that optimism?
It seems to be several factors. Abundant liquidity in the system, government moves aimed at bolstering growth, hopes for artificial intelligence, that theme again, and a notable extension of a tariff truce with the U.S. certainly helped sentiment.
Okay.
We're also seeing a significant shift from the bond market. Investors are moving out of fixed income as expectations for monetary easing are scaled back. And Beijing has restarted taxes on interest payments on government bonds, making them less attractive.
Pushing money towards equities.
Seems like it. Turnover on mainland exchanges on Monday was the second highest ever recorded, and mainland Chinese traders bought a record amount of Hong Kong stocks last Friday.
That sounds like a powerful combination of factors driving things. But with such a rapid surge, are there any potential red flags, areas of concern for China's rally?
Well, there is a word of caution. There has been a surge in loans for stock purchases, margin debt. It's climbed to its highest level since 2015, just 10% shy of an all-time high.
Leverage building up.
Exactly. That often signals speculative froth when it reaches such levels, so something to watch. On a broader emerging market note, assets are generally inching higher, particularly India. India is seeing positive sentiment from tax cuts and, interestingly, thawing India-China ties, even as U.S. tariff concerns linger.
Okay.
So China isn't entirely alone in its positive momentum, but the speed of its rebound and that reliance on margin debt are definitely worth watching closely.
Definitely. Okay, let's quickly touch on a few other key areas showing significant movement. What's happening in the cryptocurrency space right now? We saw some big moves last week.
Yeah, we've seen a bit of a pullback recently in Bitcoin and other cryptocurrencies after those record highs last week. Bitcoin is down to around $115,401 from, over $124,000.
Quite a drop. Why the pullback?
Well, it seems largely attributed to wholesale price data that kind of dampen optimism for interest rate cuts. Lower rates typically boost risky assets like crypto, so that data hurt.
Makes sense.
Additionally, Treasury Secretary Scott Bessent's statement that the U.S. doesn't plan to acquire more crypto for its Bitcoin reserves certainly played a role. Didn't help sentiment.
Right.
Ether, XRP, Solana, Dogecoin. They've also seen significant drops. Looking ahead, Federal Reserve Chair Powell's comments at Jackson Hole and the Fed's upcoming meeting minutes. They'll likely be the most important drivers for crypto prices this week.
So macro is still key for crypto.
Absolutely. It shows just how much macroeconomic factors influence this space now, much like traditional assets.
And what about the U.S. dollar? Given all these global shifts, how are global investors positioning themselves? Are they hedging?
This is fascinating, actually. There's been a notable reversal. Global investors have actually reduced their hedges against a weaker dollar. They're back near levels seen before the tariff turmoil back in April.
Really? They're less hedged?
Yes. It's a significant shift from previous months when hedging had increased quite a bit. Despite warnings earlier that equity investors outside the U.S. would pile into hedges, the hedging ratio has actually decreased.
So the fear hasn't materialized.
It suggests the dollar threat has yet to trigger, as previously feared. Partly, perhaps, because investors might still view the dollar as a long-term safe haven, a hedge itself, even if its short-term correlation to U.S. equity losses shifted a bit in April.
Interesting nuance.
It speaks to a subtle yet crucial shift in global confidence, perhaps, in the dollar's underlying stability, despite everything.
Okay, finally, let's explore something that could potentially fundamentally change how many of us save for retirement. President Trump recently signed an executive order opening up 401ks to private market assets. How big of a deal is this for your retirement savings and the broader financial landscape?
This is huge. It's truly being called a golden goose for asset managers and potentially one of the biggest changes for retirement savers since the invention of target date funds decades ago. I mean, imagine a $12 trillion retirement savings market 401k, mostly which was previously pretty much untouchable for private equity. Now is potentially accessible. This could be a massive boon for major private asset firms like Apollo, KKR, Carlyle, Blackstone.
Why were they untouchable before?
Historically, companies just kept private assets out of 401ks, mainly due to fear of lawsuits over relatively high fees compared to public market funds.
Ah, the fiduciary duty concern.
Exactly. Also, context here. The number of publicly listed U.S. companies has steadily declined since 1996. Businesses are increasingly raising billions privately, avoiding public compliance costs. So there's less opportunity in public markets alone.
Right.
Trump's executive order aims to limit companies' risk of losing those lawsuits for violating their fiduciary duty. There was a White House report suggesting retirement investors would benefit from diversification, higher risk-adjusted returns, and higher retirement income.
That sounds potentially transformative for individual investors, doesn't it? Offering new avenues for growth. But what are the counterarguments? What are the risks involved for everyday retirement savers like you?
Oh, there are definitely critics. Many call it a Wall Street cash grab that could put retirement savers at significant risk. They point mainly to potentially high fees. For example, interval funds, a type sometimes used for less liquid assets, have average expense ratios of 2.5%, compared to just 0.3% for typical target date funds. Big difference.
Yeah.
So concerns are raised about diminished resources for retirement due to those fees, and also a lack of transparency. Private assets are, by definition, less transparent than public ones.
What's the industry's response to that?
Well, private equity firms counter-argue that net returns after fees are the proper measurement, not just fees alone. And they argue that private assets offer valuable diversification, especially since many retirees are currently over-reliant on just a handful of public tech companies, for example.
Diversification benefits.
Exactly. They point to models like perpetual funds or the Australian National Retirement Savings Plan, their superannuation system, which already allows private assets, as successful examples.
So when might we actually see this happen?
Well, it's important to note, changes won't happen immediately. The Labor Department has 6 months to clarify the rules, and even then, employers could still take years for due diligence because of that potential legal expense. Lawsuits can cost $2 million or more each.
So caution from employers.
Definitely. Target date funds, which hold about 40% of 401k assets already, are likely the first place private assets will appear, as they're managed by professionals who can do that diligence.
What an incredible deep dive today, seriously. We've journeyed from the surprising resilience and that nuanced bifurcation of the U.S. stock market to the high-stakes dance between the Fed and market expectations and those stark divergences we're seeing globally, Europe's challenges versus China's surging markets, and then, of course, the emerging trends in crypto, dollar hedging, and this potentially game-changing shift for private equity and 401k. If we kind of connect this all to the bigger picture for you, it's clear the financial world isn't just in motion, but actively reshaping its very foundations.
Absolutely. It really is. What's fascinating here is just how quickly the landscape can change, and how understanding these underlying dynamics, the why behind the headlines, can empower your financial decisions. Critical thinking, continuous learning, they're truly essential to navigating this complex, interconnected world of finance. More than ever, perhaps.
So as we witness both the surprising resilience of certain markets and, frankly, the growing pains of others, and as the very avenues for your personal wealth creation expand into previously inaccessible territories like private equity and 401ks, consider this. What new strategies or perspectives might you need to cultivate to truly thrive in a financial world that is continually reshaping itself? Thank you for joining us on the Deep Dive today. We'll see you all tomorrow morning with new headlines from major financial magazines.